Really what I want to do and what I've seen real estate investing is people make mistakes. And it's fundamentals. And there's a lot of stuff Tom was talking about, some really fancy investments in Argentina and vineyards and stuff, and that's all great. But you got to understand what you're doing, what your returns are, just the real basic stuff. Couple things first thing, economists, you guys, economists make predictions. You know why we have economists? To make astrologers look good. Okay? They don't know either. Some of the things that are happening, they don't know. And, right now the market, I'd say, there's stock markets, there's lots of things. Real estate, is it a little crazy right now? Are things a little crazy? And do you feel maybe you're out of control or you can't control it? Because we can't. All we can do is the investments, whether they're stocks, bonds, 401ks, we have a little control over what we invest in and why we do it. And that's what I'm going to really try to get down to today, just very, very basics. The Warren Buffett quote of his that I like is really good. He says, we attempt to be fearful when others are greedy, and greedy when others are fearful. That's a basic fundamental. Is it a little fearful right now? Or anybody feel good when they read the paper every day this week? Is it a little crazy? It's, oh my God, what's going on? Another great thing I like, Peter Lynch wrote a book, gosh, how many years ago? Beating the Street, 10, 15, quite a bit. But really, what it got down to, and he talks about Wall Street and herd mentalities and people following the herd and stuff. And he says, if you invest in something you know, that you understand, that's close to home. And I think one of the examples, his wife and daughter started buying a certain brand of jeans, and you go, huh, interesting. And all the kids around started buying, well, maybe I invest in the company that makes those. And when you talk about real estate, it's one of the first things, real estate is a tangible asset. It's real. You can touch it. You can see it. You can touch it. So it's real estate. And all we can do is control, we can't control anything that happens with the market, but we can control what we buy and when we buy it. Whether it's stocks, bonds, and that sort of things. One last thing, Vince Lombardi, the basics of football, blocking and tackling, right? Fundamental, basic things that you do. Baseball, you say, throw the ball, catch the ball. So what can we do in real estate that's very fundamental? And the one thing that I've seen is to understand what you're investing, why you're investing, and having a game plan. If you go into a game as a team and you got a plan and you execute the fundamentals, you're probably going to win. I also apologize for being late this morning. I'm a soccer coach, a 9-year-old boy. We won today, first game of the year, 6-3. So that was good. So that was 8 to 9. I was yelling at him, going, I got to keep a little bit of voice here, So blocking and tackling, the very, very basics. And I think the basics of real estate are to understand what you're investing in and why you're investing in it. What's your strategy? And this is what we're going to do today. And how do you analyze those things? And I'm going to talk residential real estate, basically. There's a lot of exotic things, but it's no different than, Tom's saying, an Argentinian vineyard. Okay, that's cool, it's sexy, it's all this stuff, but okay, how much are the grapes? How much does it cost to produce wine? What's it sell for? Aren't those the basics? What's your return? And this is all we can do, whether the market's going up, whether the market's going on, whether it's going sideways. This is the things that we can control, is our analysis. Does anybody here own rental property right now? Anybody own rental properties? Has anybody owned in the past, don't own anything right now? Anybody want to maybe buy some stuff? Okay? And it's the same thing. So I have so many. I'll tell you, my first rental property was one, and probably a very familiar story. I didn't buy it to be a rental property. I bought it to live in. This is in Steamboat Springs, Colorado. I was about 27, bought a condo, lived in it. We had the Tax Reform of '86 Act, which changed a lot of things in real estate, right? And plus that kind of recession, whatever. That's when I came here in '86, because I couldn't get work there. I moved out of it. I could rent it out for about half of what my monthly payment was. I was getting $450 a month rent. It cost me $850 a month. I was here looking for work. Then the Tax Reform Act came out and changed the world of real estate investing, which legislative hazard, whatever you want to call it. But I think I paid $87 for it, and it was appraised at $47. Okay, 40 grand to sell it. So what I did, I ended up giving it back to the bank, deed in lieu. And so that's just stuff that happens. Then 4 years later, '91, I bought another property when I was in Texas on an FHA. Had to write a letter explaining what happened, why it happened. Colonial SNL, Was my banker did it? And they're like, oh yeah, a lot of people, Colonial, S&L, explainable. This is what's going to be happening for the next 4, 5, 6 years. There's people walking away from houses because they're upside down, they're renting, they're getting another house. There's going to be, they're changing rules and laws right now to that, if you did walk away from a property and you got to wait 5 years before you buy another one, there's all sorts of stuff happening, but this stuff is going to be happening anyway. So the basics, analyzing a deal. This is Cash Flow Club. So imagine you want to be positive. It's Positive Cash Flow Club, right? Okay. Isn't that kind of what? Because it can flow in, it can flow out, okay? And whether, I'm going to talk about a couple scenarios today, whether you're, am I doing good at staying in space? Okay, all right, good. Try so hard. There's a couple different scenarios, and I handed out a bit of an outline for you here. Just the first couple things I'm going to just touch on briefly here. The leveraging in real estate, basically what that means versus a fixed rate investment. Leverage means financing. Financing is kind of a challenge right now with the liquidity issues in the market. But if you were to buy a $100,000 piece of property by putting 20% down, or when I say about a fixed rate, you buy $100,000 worth of a stock investment, and you get a 10, say maybe someday real estate starts going up again, and stocks do, okay, because historically they haven't lately. $100,000 investment here goes up 10% a year. You make how much? 10 grand, but you invested 100,000, right? So that's a 10% return, right? Here you bought a house, a $100,000 house that goes up 10%, but you only invested 20,000, right? So you got a $10,000 return potentially on a $20,000 cash investment. And that's the difference between and I know if you have anything to chime in on, Tom, about stuff, you can too. But that's a fundamental. Now, there's a lot of variations on this and a lot of different ways to look at it. But that's what I mean by leveraging. That's the difference there. The tax advantages of real estate, depreciation, you divide it out by 27.5 years. You get a write-off every year on, if you're not using an IRA. I'm just going to talk about basic investing today. I know there's other ways to do it. And you get interest deductions. You get, and that's one of the nice things. If you own real estate, you have your little tax return form there, and you figure out how much you lost every year because you get to write off the interest expense on it. You get to write off your management fees, if any, if you had to, home warranties, any improvements you did to the property. You get to write that off as a loss. The consequences, of course, when you sell, capital gains, and then they want to get that depreciation back. Does everybody kind of understand that? The depreciation recapture. You wrote it off, say you had it for 10 years. You wrote off $10,000 a year. And I like to use nice even numbers. $275,000 house divided by 27.5 equals how much? 10,000. Good. I like to make it easy for me. So you had it for 5 years. If you had a $50,000 a year write-off, right? So aside from any capital gain, you have to put that 50. They want 25% of that back. Okay, so what's that? 17.5, maybe. Numbers are getting harder, but trying to focus. But anyway, you got to pay that back in your tax plus any capital gains tax. So you add those things together. So there are advantages and consequences. And I'm going to move quickly through these things just because I want to get to some fundamental analysis of properties. Downside risks. And I think you need to fully understand what it is you're doing. As I said, my first property that ended up being a rental property, I had downside risks. I probably experienced about everything I had on there. But it wasn't when I bought it, I bought it to live in and live there forever and work and have a great time in Steamboat. But the world changed around me. So things like, it's an illiquid asset. It's not liquid. You can't go on exchange and sell it. It takes time to sell. I sold a property a few months ago, but it took me almost 10 months to get it sold. When the market was hot, you can sell it quickly, but it's not something you can count on. You can't get in and out of it like you can stocks and bonds. Liquidity. Down markets, loss of anticipated appreciation. We're in the first, I think properties for the last 50 years have averaged going up 5% a year for many, many years. These last couple of years have been the first time in many, many years where values have gone down. What happened is liquidity was way too much with all the shenanigans that were going on Wall Street, and money was too easy, so it drove the asset price up, way beyond what it should have over that period of time. And now we're kind of, we're doing this. So we're going to swing below the line for a while to get adjusted, but we'll be back on track in a while. People. But there's a lot. So thank you guys very much.